Well, we close out the month of August and the end of the US summer doldrums. Will we see higher volatility? At the moment, we are seeing US equity markets and global equity markets fairly well supported and pushing a little bit higher. We see the US dollar closing out what's been a pretty good month up against all G10 currencies. But will that continue as we go into September, where traditionally it does pretty well? We look at trades in the Aussie dollar, the euro, the pound, and also the gold. It's time to get in front of the charts. This is the trade-off. Well, hi there, I'm Chris Weston, Head of Research here at Pepperstone. And as always, I'm going to be joined by Blake Morrow from Forex Analytics. And we will be talking about all the big talking points in the financial markets. We'll be looking at the different setups, the trades that we like, and some of the trades that you guys are looking at as well. But before I do, we've just had it straight through the hot through the press. YouTube have sent us this lovely little plaque just to show us 100,000 subscribers to the Pepperstone YouTube channel. Of course, the trade-off is a must post of the channel. So thank you for everyone who's subscribed to the channel over time. And thank you to Blake, who I'm going to bring into the channel now, who's been right at the epicenter, as has Michael Brown and Ryan as well, as part of the shows, Quasar and all the other people who have been very much involved. So great to see YouTube recognising the growth, and hopefully we can get to I think what's the goal one, 1 million subscribers or so. So obviously a bit of a way to go off. But thank you, Blake, for being part of the channel and obviously being part of the mass post of the show as well. So continue going on forward.
It is my pleasure, and I just want to thank everybody who listens in and as part of this. Yeah, I mean, you guys are what makes it, and we're trying to incorporate your comments, your questions into the show just to make this the greatest trading show on earth, and and well beyond the UK trade-off as well.
Recognise, mate. Recognise. That's going well. Anyway, long forward. Hopefully we can generate some alpha going forward. We'll see what happens there. Anyway, let's go to topical thunder. Blake, I want to get some of your views on some of the big talking points on the trading floors. We're closing out the month of August. We roll into September. We can go into cover that in the looking ahead section. And, it's been a whippy ride, I guess. The dollar's closing out on a firmer footing. Up against all major currencies. I think the MEX has been second best. It's done quite well. Obviously, carry's still very much in focus there. But we've started to see a re-emergence last 4 or 5 trading sessions. The Nasdaq's broken for its 61.8% retracement. We've got Apple looking like it wants to go and fill the gap into 190. Google's broken out to the top side. The S&P's looking pretty chunky at the moment. Maybe there's some rebalancing going on there. But generally speaking, equities are finding their mojo. And the question I want to ask you, Blake, I mean, with volatility still pretty low, I know we're coming in and the big hitters are coming back to their desk, and maybe they'll chuck a bit of size around. We'll see what happens there. But at the moment, with vols low, equities moving up, I can talk about broad sentiment, but I think I want to hone it in onto the Nasdaq and equities. Can we see new all-time highs coming through in that market?
We're less than 3.5% away from all-time highs. I mean, why couldn't we? I guess that's the question I have to ask is, why can't it? The only thing that I am a little bit hesitant about, first of all, I wouldn't want to stand in the way, try to short equities right now, knowing how close we are. But positioning was really off, and I've called this the Michael Burry squeeze. There's a lot of hype around him. I'm sorry. I mean, it is. I mean, think about it. He's a longer term guy. He's positioned for some, major crash in the months ahead. But, when his positioning makes headlines, it gets people all excited about being on the short side. And next thing you know, you get a squeeze because position's offside. And that's what's happening. Low volatility environment. VIX just filled a gap. So that's something to pay attention to. But the VIX is down. Volatility is down. Stocks are stronger. Could we push to all-time highs in the Nasdaq? Again, I ask the question, why can't we? Now, I have to also imagine that all the traders, whether they're on the French Riviera, they're in the Hamptons, wherever they're at, I shared with our community like the old GIF from the GIF from the Wolf on Wall Street when they're just on their yacht, partying it up. I can just see people, big money, just sitting there salivating, saying, man, I cannot wait to get in front of my computer the first week of September lay into this. So, hey, volatility is low.
Yeah.
Let it rock and roll.
Let it rip. Let it rip. Well, mate, I want to kudos to you, Blake. I know you've got a couple of holiday houses in the Hamptons, but you still front up. You still get in front of the screens and turn up for the show. So thank you for that. I agree. Volatility is key here. If we were to see realised vol moving up, then you're going to get the volatility dynamic funds looking to take money out of the market as vols push up. CTAs would then have to adjust, and you're going to get this kind of flows coming through. Dealers would be increasingly short gamma, and that would have big implications as well. So, for me, on the higher time frames, I mean, obviously you can scalp in today if you're into that. But if you're looking at the higher frames, 4 hour, 1 hour, one daily chart, 1 week, I think you make a great point right now. It's going up. I'm either long, I'm not, and I have no position in those equity indices. But I think shorting in this current domain is a lower probability trade. So I think it favours further upside here. But I'd either be flat and no position or long. But I think shorting is a tough one with those dynamics. Those dynamics need to change, and then you're going to have a higher probability of getting those shorts away.
And that brings us to our next topic, Chris, the PCE and NFP. I'm more thinking about it from a dollar play and dollar point of view, which I want to talk about here in a second. But that really kind of goes back to your previous comment. I think if the market is going to turn, what we've seen bad data drive the market higher. And that's what's happened over the last couple of, we could actually go into last week too. People are of the view right now, if the data is relatively weak. Today's ADP data in the US, I called it a Goldilocks number. It was weak, but wasn't too weak. And if you see US data weaken, but it's not like super weak, that says, the Fed's going to stay defensive. Maybe they're not going to raise rates this next month. And let's go ahead and rally stocks because, we're not losing jobs. But the PCE data, the NFP data, that's going to be really, really key going into the end of this week. And so I think that's what the market's going to be looking at is what's happening with personal consumption and expenditures, what's happening with jobs report. And I can't answer that question right now that bad data is going to be good for stocks, but that's the trend we've seen the last couple of weeks. I do want to also say this. The dollar's got some great setups for either direction, but I think the dollar will be somewhat binary, meaning bad data, bad for the dollar, good data, good for the dollar. So,
exactly.
There you go.
Well, I think you make some good points. I mean, if you want to play it the cleanest expression, you're going to get it in the treasury market and you're going to get it in the US dollar. What you're not going to get is the equity reaction, which could be, like you say, if we get that bad data, it just means the way that you interpret that is that the Fed aren't going to raise rates. Certainly they're not going to raise rates in September. I mean, that's a done deal. But whether they raise rates in November is a point of conjecture. And what's the terminal price? Bad data means that the Fed are going to stay higher for longer. When we get the change in sentiment comes when bad data equals bad for risky assets, and that's because we start really pricing in a recession. We're not there yet at the moment, but you'll see the reaction explosion in higher in gold, and you see that in rate cuts being brought forward as well. So at the moment, bad data is good for risky assets like tech and equities because it means the Fed are going to hold off. I think bad data becomes bad for risk when we start saying, well, actually, there's a trend developing now, and actually, we're going to start seeing the Fed having to normalise policy much sooner rather than later. And I think the PCE number and the payrolls number, the question is which one's going to be the more have the higher propensity for volatility for us as traders? And I'll ask you this question before we hand it over to China. But are you as a risk manager, Blake, as a trader? You're looking at your dollar exposures. Are you concerned with holding dollar exposures over core PCE, or are you more concerned about the NFP side?
I am more concerned about the NFP, and I do have some dollar exposure right now. And the thing is like right now I'm long dollars going into tomorrow. I don't know if I'm going to be that way after tomorrow's data. So what I'd like to have is like, and this is part of the dollar playbook, is if the dollar does strengthen because the PCE data is still showing, inflationary pressures, let's just put it that way, and the dollar remains firm, then if I have enough runway, I don't mind carrying those positions into the jobs report, if I've got already some profit. But I do think the bigger reaction is going to be the jobs report actually on Friday, because we know, and whether it's this month or maybe it's 2 months from now, we're getting really close to the data turning in a more meaningful and trending way. So, is it this month? Is it next month? Is it, in November? I'm not sure, but I know we're getting close, and I think everybody can sense that.
Well, the data at the moment is going the way the Fed wants it to do. We saw that in the JOLTS report. The time when we start seeing consistently below 160,000 on the payrolls, I think that's the time when you can say with conviction that the Fed are done. There is still a 50-50 chance they raise in November. So, this payrolls number, this PCE number could have a bearing. And then going to September, the 13th of September, when we get the CPI number, that will give us some clarity as well. Anyway, I want to touch on China because, you can't go past what China's doing at the moment. I mean, it's front page news. They've started giving us more on the fiscal side of things. Banks are cutting mortgage rates, I think 10 basis points for existing mortgage holders. Whether that frees up enough capital to see households start spending is yet to be seen. But I think it's a message that gets out to people that the authorities have your back and they want you to spend. And people in China typically do pretty well aligning their investment and their spending habits with what the message, the psychological message that they're hearing from the government and the central bank. We've heard other various messages that are coming through. Certainly stamp duty being cut by 50% is, again, not something that's going to change the game. But again, it's just something that says we want the stock market higher, we want it supported. And if you buy when you're getting told to kind of a sort of indirect message like that, then typically you've done pretty well. So we saw a bit of a short-term boost for Chinese equities. We are seeing a lack of conviction. So we're seeing markets spiking higher on the open, sellers coming in. So there's not huge conviction to make this bull trend. Dollar CNH has started to move up a little bit again, and probably would be trending higher if it wasn't for the fact that every day at 11:15 Eastern Standard Time, the PBOC come and push back on that yuan strength with record fixings every day. And I would love to try that. Aussie dollar's probably a better trade there. So how are you seeing China now? Is there something in there in the substance that gets you excited that says this can last, or is this just a trading market for you?
Well, first of all, I think you said like one of the key words that need to be talked about is China fiscal stimulus. Because I think the big issue with China right now is confidence. It's a confidence game, and when you see Evergrande and Country Garden and everything else in the news, it's freaking out the Chinese consumer, because the Chinese consumer right now is hunkering down. They don't want to buy that other property. Matter of fact, they'd rather be selling the property. They don't want to. They don't want to be spending. They want to be they want to be saving, and that right now it's sentiment. It's kind of like that inflation genie. When the inflation genie, as we have obviously seen over the last year, gets out of the bottle, it's hard stuffing that genie back in the bottle. Sentiment's the same way. If sentiment turns, especially with Chinese, for crying out loud, you have a culture, which I happen to be half Chinese. You have a culture that is just predisposed to really just save, and you're trying to completely change a culture into more of a consumer-driven culture and society. It's obviously tough, and so when they get in their saving mode, it's hard to switch sentiment and change it. And I think that's what the PBOC is really struggling with right now, and I think that's what China's struggling with right now. So, and you can see that the market is obviously not buying it, because when you have these gaps up, you see Hang Seng or Shanghai, gapped up 5%. And it closes the day up, whatever it was, like 2% or 1.5%. I mean, that just shows you lack of conviction that the market has that China.
International investors are just not getting involved. You can see that in the flows. But I think, for me, dollar CNH offshore yuan was the trade of the year for me. When you're seeing these export numbers just dissipate, massive collapse in foreign demand at a time when China was ramping up their manufacturing involvement in the world, then it just made sense to give their purchasing power to the importers, foreign importers. But the problem is that, that creates a weak yuan. China will be exporting their deflation around the world. But the problem is that you also incentivize capital outflows, which tighten financial conditions. So there's this really nice balancing act in China at the moment between, wanting a weak yuan to have people support their goods and support their purchases, but also stopping capital outflows, which create tighter financial conditions when China is slowing. So what it does is it creates intraday, trading opportunities to range trade, I think, rather than just go for that outrageous trend, which I thought was going to happen. Anyway, we'll see what happens there.
We'll see. We'll see if it does happen. I'll tell you what. If we do get a breakout in the U.S. dollar CNH, I'm gonna start hunkering down.
Have huge implications for dollars more broadly. If we did see the dollar, going on a one-way trend, the dollar would rally against euro and against the Aussie and Kiwi and stuff.
And I know we're up against really big resistance around current levels, but let's not just forget the trend of the last year has been strong dollars, weak yuan, or renminbi. So anyway, great topic of conversation. I think China should be on your radar. The headlines are going to be moving, especially for those of you that are, trade in the Asian time zone, like those of you that are in Australia and New Zealand and around the Pacific area. Anyway, I want to go to our next topic, Chris, and I want to talk about looking ahead because this is like the last month. I've been telling traders this is like my least favorite month to be in front of the computer. But at the same time, next to like the Christmas holiday, if you celebrate it, it's the end of December. That week, the week before, it stinks. The lack of liquidity, things are very jumpy. But at least then we get to look forward to opening Christmas gifts. Those of us that celebrate Christmas or Hanukkah or whatever. Anyway, the reason why I bring this up is everybody's trying to wrap up the end of summer, but looking into September, we've got a lot happening, and I want to ask, like, if there's anything that I might have missed here, but I just want to say, on September 4th, as soon as, traders start getting in front of their computer, we have the RBA. On the 6th, we have the Bank of Canada. On September 8th, we have the Canadian employment data, because it's not going to be this Friday, like the U.S. jobs report. It's going to be next Friday. I guess it would be next Friday. On the 13th, we have U.S. CPI. On the 14th, we have the ECB. The 20th, everybody's waiting for it. We got the FOMC, and that's going to be obviously a market mover. But on the 21st, we have the Swiss National Bank, the Bank of England, and the BOJ. So lots of central banks, lots of events that are happening this next month. And remember, full liquidity comes back to the market. And I always try to explain to people, that first week back after, right after the RBA meets, you got all these asset managers, and they're in meetings. They're trying to figure out how they want to position themselves going into the end of the year. And September typically is it's a down month for the most part. So that means there tends to be some risk selling. So anyway, those are some things that I'm thinking about going into next month. Is there anything specific that you're thinking about going into September?
No, I think you covered them off very well. I think the CPI number on the 13th is going to be a really big one there. Just going to sort of solve the market sort of debate whether we get November as a rate hike from the Fed. The FOMC meeting will obviously be really well watched because it's the quarterly meeting, and therefore we get a new set of economic projections and dot plot projections, and we'll just see, whether the Fed are starting to see some vulnerabilities kick in. But I suspect they probably wouldn't be. And we probably won't see huge changes playing through there. So I think you've covered it off pretty well. I think, having an open mind, to how this all might go down. I mean, I could easily make a case that the market goes lower, risk assets go lower, the dollar rallies like we've seen. Last 6 Septembers in a row, we've seen the US dollar index rally. It is the worst month in the last 15 years to be long the S&P, the Nasdaq, the Oz 200. Equity markets generally do pretty badly, but the percentage actual change is not great. But the dollar has worked pretty well over the last 6 September. So this time any different. I think the FOMC meetings, the CPI number is going to be really important, and that's going to set us off. So we'll have to see. I mean, can we get new highs in the Nasdaq playing through there? We're going to have to be looking at Nasdaq. We're going to have to be looking at Microsoft. We're going to be looking at IBM. We're going to be looking at not IBM. We're going to be looking at Apple. Those kind of names, and of course. Can we start seeing a higher VIX? I mean, if we were to see realized volatility and implied volatility, not just in equities, but in rates moving up as well, rates volatility, then that would be the trigger for me to start looking at shorts much more aggressively. Because when vols move up, that's when you see de-risking and deleveraging playing through. At the moment, volatility is too low, and people are going to drip feed cash into the market. So yeah, lots of event risk playing through there. I think you've covered it off pretty well there. So let's hope for a lively one. But in volatility, I think is absolutely essential. It's not just essential for our risk management, understanding how much risk we're taking on, our position sizing, but also directional. And yeah, the volatility itself plays into flows and who's moving money around. So really, really important there. So that's one of the key central points for September as liquidity comes back on. So good to cover it off with you, Blake, and I look forward to hopefully what's going to be a lively September. Anyway, let's go to the charts that matter. Let's go to That's a Setup. All right, Blake, I want to touch up with our old recession friend, or recession hedge, Mr. Yellow Metal Gold. If we can bring that up. Look, yeah, we've seen a nice move up from those lows just above 1880, and you've had a nice melt up in that situation. We've hit back into the 61.8% retracement of that sell-off we saw between July and August, and yeah, we're starting to find a few sellers kick in. Didn't see a huge amount of resistance at the 38.2%, but you have seen some heat coming out of real rates. I mean, 10-year real rates were going up into 2%, and we've just seen them pull back about 15 basis points or so. The US dollar in the last few days has lost a little bit of ground, and that's promoted. I don't think people have necessarily priced in a greater chance of recession, but we have seen some evidence that the data doesn't suggest we should see further rate hikes, and maybe just some positioning that's come through in a market that was pretty unloved. So how are you seeing the gold market at the moment? I mean, I personally have no real reason from a longer term time frame to be short. Even though I say the investment case is not great, but yeah, I think right now the momentum indicators still suggest either being neutral or long. But that 61.8% has been pretty fierce resistance. How are you playing this, Blake?
Well, first of all, I'm not playing gold. I'm because I'm playing the dollar predominantly. And I have to say, I know we talked about it about 2 weeks ago off the bounce off the around the 200-day moving average, the 1900 level. There was a quadruple confluence down there, so we got a nice rally from there, and actually it exceeded further than I thought it'd go. But the reason why I think this is a great setup, Chris, going into the next 2 days, is because if you drop a trend line from that red circle that you have up there at the spike highs, you drop it just across the tops, you have a descending trend line. It coincides with right where we're at, right around this 1945 level. So in the spot market, so we know that a sustained breakout of like 1950, that's bullish gold. And if it does reverse and we see some dollar strength, because let's just say US data is not backing off, and we see the dollar rally, gold's probably going to head back down towards 1900. So I think it's a great setup right where it's at right now for bulls or for bears. Just, I think you got to wait for the data the next 2 days.
Yeah, right. And we clear that out. I mean, I do think the key level that we're watching most, more importantly, I mean, I think we buy strength. So, breakout above that 61.8 takes us into 1981. That's the big level. That's where CTAs will need to cut back on short positions. Yeah, that's where the sort of line is. They might, they'll start averaging that down. That'll just propel it higher. But you can see that 1981 level has been the big supply level for gold. So I kind of want it to get there, not just because I want to get long into that level, but just to see how it reacts. I think that's such a big level, just from a positioning perspective, but also from a technical perspective. We've tried that level so many times, and it's been a wealth winner every time. So yeah, I want to just see it into that level, just to get another sense whether it can break through.
All right. Well, that's a good one. I think that's a great setup right where we're at right now, and I think it could go either direction. And I think you've got a good setup, and I love setups. The setups are ones that you'd be watching.
I mean, again, this is a pure read. If bad news will be good for gold. I mean, bad data will be good for gold, and that's another easy one. If you want an easy trade, if you want to understand your risk, we've got this data point coming out. What's the reaction in markets? You're not necessarily going to get that in the equity market, so it's hard to see and manage your risk, because don't know if it's going to be bad for markets or good. But with gold, that bad data will be good for gold.
Right. It's like a binary dollar play. Gold's the same way. It's funny, going back to our previous conversations about, the jobs report and PCE and all that other stuff. It's like I can make the argument about, buying the S&P or stocks or risk on good or bad data, but with gold and the dollar, it's pretty binary. It's pretty black and white. So love the setup. Okay, I know we need to move along. I'm going to take us to our next setup, which is the Aussie yen. It isn't actually, this is a viewer question from Mike. Mike said he loved the euro dollar long play. Hopefully, Mike, you got to play the euro dollar long off that 108 support, big 200-day moving average. But he wanted to take a look at the Aussie yen. Thought it was very similar about the reaction. Now, with the Aussie yen, I want to point out that we are at the 50% retracement. We've broken out of a descending channel, and we are stalling at a broken trend line, which is in blue. And if you take it just down to a 4-hour chart, that really capped us today. So, and you can see some highs. If you just look left and go look at the highs back on August 15th and August 9th or 10th, right around there, we'd spike right into these levels that we're finding resistance at. So the Aussie yen's not super clear to me, but I'll tell you something that is clear is if you look at the 6J, which is the yen, the continuous contract of the yen as a whole, it looks like it's ready to break down. And so if that does happen and we see the dollar yen spike up to 150, Aussie yen's going to get dragged, whether it likes it or not. It's going to get dragged above that 95.50, 618 retracement. So that's kind of how I'm seeing the Aussie yen. It's not a great clean setup to me, but I wanted to address that because Mike asked us last week. What do you think here, Chris?
Well, I think you're right. The problem, look, if you've got euro yen, which has just broken out, we've got sterling yen like it wants to break out, and I quite like long. And I was going to use sterling yen longs as my play of the day. The thing that concerns me is that we're about 10% above the 200-day moving average, and go over the last 15 years. Whenever we've got that premium, that's been where the sort of mean reversion trades kick in. And of course, you've got. I don't think Ministry of Finance are going to come out and necessarily buy the yen in the market anytime soon. I don't think we're there yet, but obviously it remains a risk. So, I've looked at other trades there, but I think in this environment with volatility still pretty low, equity markets trending higher. I think this is just a yen trade. I don't think this is necessarily an Aussie trade. If China continues to find buyers, and we don't know if that's a big if, then the Aussie is probably a great trade to be long against the yen in that environment. So, I think if you're going to be long, if you're going to get that breakout, then we want to keep an eye on the Hang Seng. We want to keep an eye on the copper market, and that needs to push higher. And we probably need to see a higher, a move lower in dollar CNH as well. So good China. If you're bullish China, this is the play. Otherwise, for me right now, I still prefer sterling yen and euro yen as a sort of a momentum move there. So we'll see what happens there. I want to take another viewer question. Ian Peacock wrote to me directly about the cable trade sterling against the US dollar. If you have a look at it on a weekly chart, we were talking about this, that it actually printed a bearish outside week reversal last week. That low has been held. So obviously with reversals like that, you want to see price make a continuation and trade through the lows, which is why so many people use sell stop orders and trying to ride that momentum. Now those lows have held in. What we can see on the daily chart, Blake, is you got that kind of head and shoulders pattern playing through. The neckline was broken. We got the false breakout, and then we've started moving to the upside. Obviously, just broad US dollar sell-offs in the last couple of days has helped that, but the sterling's has been an outperformer. And what I wanted to do was looking to sell weakness, and as it moved down, look to add into that position. That trade hasn't materialised. The question is have we got 128 on this at the moment? There's not a lot of data driving the pound at the moment. We have to wait for other information. The Bank of England, the next meeting is fully priced at 25 basis points. It looks like the supply comes into 128. I want to trade this into 128, given that false breakdown of their neckline. But how are you playing this at the moment?
Well, I'm not playing it. I actually shorted a little bit earlier today, and I'll be out of that trade probably by the time I get off the show. Well, that's not true. Probably in the next hour or two before I head to bed. Anyway, it's interesting. This if you kind of use your imagination, because I can't draw on this chart that you have because it's a static chart. But we had a head and shoulder pattern set up, and that breakdown or that false breakdown that you point out, it actually caught some traders off guard. It caught one of my colleagues, Dale Pinkert, caught him off guard. He's already covered. I think a lot of people that were short sterling, playing the dollar on the long side, they kind of got shook out over the last couple of days because the dollar's pulled back as a whole. So I think it's more of a dollar story, but I'm still wrangling with the idea, Chris. What is going to happen with the sterling as the UK deals with stagflation? And I can't imagine it being super bullish for the pound, but we'll see. I mean, the jury's out right now, right?
Well, absolutely. I mean, it's
kind of new territory.
I think that this, again, you make a great point. When we saw it trade through those lows, we held the lows on the weekly, but yeah, there's a lot of people who were positioned for a momentum move, and I think it comes back to the point that momentum strategies, when you're buying breakouts or you're selling breakouts, quite a lot of them do fail. So you need to be taking that loss pretty quickly and just realise that the win-loss rates on some of these strategies is pretty low. But when you're in it, you've got to just extract as much juice out of it. There's no problem with losing, but when you win, you've got to try and win big, and that's where we are. So I think a lot of people were holding this one for a momentum move. It failed, and they've had to cut it out pretty quickly. So this could again frustrate them, and you could easily see it roll down and make another tilt at those lows. But I think once you start seeing that moving up, and also the volatility kick up, I think that's when order book dynamics take place, and you start saying, well, we maybe got 124, that 200-day moving average in there. But right now, it feels like if you put a gun to my head and said, where's the more likely scenario, 128 or 124? I'd probably say 128.
Oh, well, there you go.
Or 125.
128 it might be. Well, Chris, thanks for bringing that one up. And the next setup that I want to bring to you is the Aussie dollar. Now, like I had mentioned on the topical thunder, we're waiting for the PCE and the jobs report, and it is going to be somewhat binary with the dollar. And I think the Aussie is a great setup as a result. It's a bear flag pattern. The moves, above 65 cents, finding resistance. You all should know, because I think we've discussed this already here, there's a very long-term trend line connecting from the post-COVID lockdown lows all the way back from 2020. It's that black line. It goes all the way to 64 cents, basically. That's holding us as support. I'm just going to say this. If the data comes in really strong over the next couple of days, there's a good chance that the Aussie dollar could break through 64 cents, and it's going to go a lot lower. That's a bear flag pattern. It points towards 62 or 60 cents if it really wants to play itself out. One of the other divergences, and where I say it's breaking ranks, is the green line chart is the S&P. You can see the big rally in the S&P, nice squeeze that we've had. The Aussie hasn't really played it's breaking ranks here. So if the S&P starts to move, higher or continues to move higher, and NASDAQ hits new highs, it might drag that Aussie and break this bear channel and take us back above 65 cents. And maybe start to get a move back towards the 200-day moving average. But it's a setup, and I think it could go either way. Chris, how are you looking at the Aussie here?
Wait for the market to reveal itself, and I think you can increase the conviction, because I think you've got two very, very clear defined levels that you can work on, and that can affect your trading bias and how you're going. So I think this is one that you put on your radar, get your alerts out, and when it completes, then you can trade this. But yeah, I think China's that has moved away from the S&P, but I think you've got to keep them more focused on the CN50, the H shares, and keep an eye on those. Copper, can we break convincingly through 380 a pound? Iron ore futures, they're probably what I'm looking at more closely as a proxy rather than the S&P. Those correlations with the S&P do come and go. Put a correlation matrix on TradingView, you can see that coefficient pretty clearly there as well. But yeah, I think you've got a really, really nice defined range, and I think once it breaks either one of those, then I think the propensity to trend will be there for me. So I like it. Again, it's one that I'm just going to revert to. I've got my alerts. Which way does it go? I don't know. Bear flags, typically 80% of them go down. And again, that really comes down to China. We're saying this before the PMI numbers coming out in the session. They're literally going to be coming out in the next hour and a half. That could really impact them, and we'll have to see what happens with the outcome there. Anyway, let's go to play of the day. Yeah, as I said, I wanted to go sterling yen for the breakout. I think it's got further upside potential, but I wanted to bring up Euro CAD because it started to break out, and there's risks with the yen. We all love trading the yen. I know clients really, really dig what's going on there. And this is a sort of a lower beta pair. Now, I will say that we talked about what's happening in September. The ECB meeting is going to be a really big one there because the market's pricing that at 50-50 whether we get a rate hike. And so it is going to be pretty live. And again, I'm saying this before we get the European CPI numbers. We've seen the German numbers. They were slightly better or slightly hotter, should we say. But we're saying this before the EU CPI numbers that come out in the session ahead. But look at this. I mean, in terms of the actual technicals, Blake, I'm seeing this breaking out of the range. It feels like this is something I want to go. I'm going to be looking to trade this from the long side. I'm going to take the time frame down, but you can see the overview here. And I just want to, as soon as some buying comes back into this, I'm going to be long. Yeah, okay, you're doing this before the CPI numbers, which could really dictate and influence that ECB meeting mid next month. But yeah, I think this has got structurally, it feels like this is going to squeeze up into 149. It's got that nice defined consolidation range. We're breaking to the top side. I feel like this goes up higher, and I feel like this is going to go 149. So yeah, I'm going to be trading this with some, take the time frame down, momentum come into that, and yeah, I'll be taking this one up for 149 or so.
Well, I tell you, Chris, despite the stickiness that we see in crude oil, and I say stickiness, the strength that we see in crude oil, it hasn't translated to Canadian strength. So, man, if crude oil rolls over, you could have some serious Canadian dollar weakness.
I could make a convincing case that euro goes much lower. I mean, the economics in Europe are looking as vulnerable as they can in G10. But the price is the price, and right now the market's telling me that they favour euros over CAD, and I think this can kick higher into 149. So I'm sure there's people out there in the audience who are sitting there going, Europe looks a basket case. Did you see those manufacturing numbers? Did you see those service numbers? Inflation is going the right way, and we're starting to see somewhat more concern from the ECB. But yeah, right now this is starting to move a little bit higher, and I think it continues to kick.
I think about 7 or 8 hours from now, we're going to have the Eurozone CPI number, and that could be a great.
Well, it's a concern. It's a concern. So yeah, we'll see what happens.
Yeah. All right. Well, thanks, Chris. I'm gonna give you my play of the day, which happens to be the dollar Swiss. It's the Swissy, and Swiss to get the cheese is the title. And look, I have to say this: I don't have a position short dollar Swiss. I'm trying to get short. I knew the key resistance was at 88.70, 0.8870. We came within a couple of pips. Some people in our community knew that we've been looking at this descending channel. It's a 50% retracement, yada, yada, yada. Anyway, if I can get short somewhere near there ahead of the jobs report, that's what I'm trying to do. I think U.S. data is going to start to weaken, and I want to play into what could potentially be weak data. The flip side is if we break above 88.70 on good data, strong U.S. data, and let's say I'm wrong, which I sure as heck could be, then a reverse short dollar Swiss, move back up to the 200-day moving average. I'm gonna play a stop and reverse trade on the dollar Swiss if I'm short and I get stopped out. So that's how I'm gonna play the dollar Swiss. I'm gonna try to play it short. I've got orders out ahead of the jobs report on Friday, and wish us luck for those of us that are trading it.
Yeah. And for everyone out there, thank you very much for watching. If you could smack the like button, we'd appreciate that. Obviously, if you've got a setup you want us to cover that's a setup, please feel free to reach out to one of us or get into the comments section. Tell us the setups you're looking at and how they might go down, and anything that you want us to look at for next week. We'd really appreciate that too. And if you've just got a general comment about how you're trading the markets, we'd love to see that. Anyway, for all you lovely people out there, we'll see you next week for more of The Trade Off.